Hi, in this video, I'm going to cover concepts associated with supply. Let's begin with the definition. In economics, supply refers to the quantity of a good or service that producers are both willing and able to sell at given prices in a given period of time. So just like demand, supply requires both willingness and ability, but now from the producer's perspective. A-level expects us to also distinguish between a supply schedule, a table that shows the different quantity of supply at different prices, and a supply curve, an upward sloping diagram that demonstrates the relationship between the price and quantity of supply. It is very important to separate supply from quantity of supply or quantity supplied in short. Quantity supplied is a single point on the supply curve, the amount a firm will produce at one specific price. For example, at the price of £10 each, the firm would like to supply 50 units. This is one single quantity supplied, not the entire supply curve. The supply curve consists of numerous price and associated quantity of supply combinations. Now, let's move on to the law of supply, which states that the price and quantity supplied of a good are positively related. When price rises, so does quantity of supply, and vice versa. There is a positive relationship between the two variables. So why does this happen? Three main reasons. First, profit motive. Higher price makes production more profitable, so firms expand output. Second, rising marginal cost. As firms produce more, marginal cost, additional cost often increases. Firms will only produce extra units if the price rises enough to cover the higher marginal cost. Third, production motives, production incentives. Higher prices encourage new firms to enter the market and existing firms to increase production capacity. So together, these explain the shape of the supply. Now let's look at the movement along the same supply, which can only be caused by a change in the price of the good itself. When price rises, there is an extension of supply. Quantity supplied increases. When price falls, quantity supplied decreases. There is a contraction of the supply curve. In both cases, the curve itself does not move. Now let's move on to the shifts of the supply. Shifts occur when the non-price factors change the cost or willingness of firms to produce. A shift to the right from S1 to S2 indicate an increase in supply because at every price, the quantity supplied is greater than previously. A reduction in supply, a decrease in supply can be demonstrated as a leftward shift of the supply curve, for example, from S3 to S4 in this case, because at every price, the new quantity supplied is smaller than the previous old quantity supplied. Shifts happen even if the price of the good does not change. Let's now go through some of the supply shifters one by one. First, change in cost of production. When wage becomes cheaper, when raw material costs become cheaper, the profitability of supply increases. Firms tend to shift their supply curve to the right. Second, changes in productivity and technological improvements. Higher productivity means firms produce more output with the same inputs. This helps lower average cost and increase profitability, and therefore the supply curve will shift to the right. New technology will also shift the supply to the right for the same reason. Besides, changes in indirect taxes is a supply shifter. Tax adds on to the cost of production and reduce the profitability. Therefore, it causes the supply to decrease and shift leftwards. On the other hand, changes in subsidies can be viewed as a negative tax. Subsidies help reduce production costs, encouraging firms to supply more, therefore shifting the supply rightwards. Also, changes in number of firms in the market. If more firms enter an industry, the market supply will increase. If firms exit, the market supply will decrease. Furthermore, changes in expectation about future prices. If firms expect prices to rise in the future, they may restrict current supply. If they expect lower future prices, they may supply more now. Weather and natural factors are also supply shifters, and they mainly affect agricultural products. Favorable weather conditions increases supply. Bad weather, disease outbreaks, or natural disasters decrease supply. Laws and regulations will also be supply shifters. Stricter regulations such as safety standards increase production and compliance costs and reduce supply. Deregulation typically increase supply. Changes in price of related goods are also supply shifters. If firms can produce either one good or another, we say that the goods are in competitive supply, for example, wheat and corn. When the price of wheat increases, it is more profitable to increase the quantity supplied of wheat. Since more land are being allocated for wheat production, the supply of corn will decrease. And two goods are said to be in joint supply if they can be produced together, like beef and leather. An increase in the price of beef will induce the suppliers to increase the quantity supplied of beef, and automatically we're going to have more supply of leather. Finally, A-level economics also requires us to understand how individual supply becomes market supply. Individual supply refers to the quantity supplied by a single producer at each price. Here I have drawn two supply curves, each for firm A and for firm B. The market supply is a horizontal summation of all individual companies' supply curves. For example, at the price of 10 pounds, would like to supply 20 units, while B would like to supply 30 units. If the market consists of just two sellers, A and B, then the market quantity supplied at the price of 10 pounds will be 20 plus 30, 50 units.